Yeah, News 4 learned the Office of Personnel Management met with federal agencies today and told them to begin letting people go. Those agency leaders were told to dismiss probationary employees. That means workers who have typically only been with the federal government for 1 or 2 years. That's before all their civil service protections kick in. Hundreds of thousands of people could be affected by this. In fact, within the past hour, the Department of Veterans Affairs, the VA, announced it was letting go of 1,000 probationary employees.
So we have a greater than 50% odds that over 100,000 jobs will be cut in the federal government. But here's where it gets really important. They're also cutting contracts. Before we get into the Polymarket data, if you find this video helpful, please share it and click the like button. Certainly would help out the channel and I would appreciate it. Also, towards the end of the video, I am going to do a Nashville specific update on housing and also my opinion on how I think this could impact the housing market. Now let's take a look. Here's the Polymarket poll, the number of jobs Elon and Doge cut in the first 6 months. And you can see that the odds of over 200,000 is at 1 in 3 right now. The odds of 100 to 200,000 jobs, 25%. According to Fred, we have 3 million jobs, federal jobs, in the government. So cutting over 200,000, that's not even 10%. Now let's take a look at what Anna Wong said about this because she lives apparently in DC. I didn't know this, but here's what she said. There's various anecdotes swirling around my neighborhood, posting boards that federal and grant contractors are already laid off. Contractors are counted as private sector employees. They are on average more well-paid than government workers, and with contract freezes as part of Doge, the impact of the reduction in federal government spending will extend way beyond the 2.3 million or so federal workers directly employed by the federal government. So she's saying that there's 2.3 million, 3 million, 2.3 million. We know there's millions. Okay, in 2023 fiscal year, the government spent $759 billion on contracts. Contractors and grants account for more than 6 million employees. These are not federal employees. So now we're talking about close to 10 million employees. Light also wrote a report on the true size of government at the Volcker Alliance and estimated that in 2015, for every federal employee, there were 2.6 contractors or grant employees. Again, that puts the number much closer to 10 million direct recipients of federal funds that creates employment. Okay, so what does that mean? Let's just assume that they're successful and they cut 10% of the federal workforce, 200 to 300,000 employees. That's only the federal workforce. They are going to cut equivalently, or if not more, the contractors. So we're talking about double this number, and now we're 400 to 600,000 employees, 800,000 employees. It's just hard to imagine we wouldn't go into recession. Now, let's take a look at some specifics, and then we're going to talk about how this is not going to impact everywhere equally. Now, when we look at the NIH funding in 2024, remember, they're trying to screech on the brakes for the NIH funding. And you can see that Tennessee, North Carolina, Pennsylvania, New York, Missouri, like these areas are getting disproportionately a lot of per capita funding. Here's the problem with this. There's only 7 million people in Tennessee. Okay, so per capita, it's pretty high. However, over 2/3 of the money is in one place, and it's in Nashville, Tennessee. Now, if we scroll down, and this is where the risk just gets massive. Here's some of the largest recipients of the money. University of Pennsylvania, Philadelphia, 129 million at risk reduction. University of Michigan, 119 million. Johns Hopkins, we're already seeing, the DC area is just going to get just deluged with cuts. It's hard not to imagine that the housing market doesn't crash there. St. Louis, 100 million. Pittsburgh, but these are just universities and medical. Just so you know, Vanderbilt also gets about 200 million. That makes them not on this list, but that's just their university. Now let's look at hospitals. Guess what? Vanderbilt gets almost $500 million a year, and 71 million of that is at risk of getting cut 71 million. Okay. Now add the 200 million that they get for their university. Now we're up to well over 100 million potential reduction. Now, here's the way I think about it. And because I worked in finance, this is swag. It's a wild guess on what the number is. But for every 100 million, figure there's 1,000 employees. Okay. So 1,000 employees per 100 million. It's a ballpark, right? It's going to give or take. It could be more than that. It could be less than that. But that's a very fair guess. So my gut is that if they lose $100 million in funding, at least 1,000 jobs get cut. Now, this is speculation, okay? But it's $100 million in funding. We have to be honest and expect that it's going to impact, okay? Massachusetts General Hospital, Boston, $98 million. Boston Children's Hospital, another $4 million. These are this chart does not show how concentrated the areas of NIH funding are going. They're very targeted. In North Carolina, it's the Research Triangle. Duke and UNC and the Research Triangle make up the vast, I think they get $2 billion of funding between the three of them. $2 billion. They could lose hundreds of millions of dollars in cuts, and that could translate into massive layoffs. This is just NIH. This is hundreds of millions of dollars in very concentrated areas. Let's move on to a contract. Now they're going to go after other places, Department of Homeland Security, Department of Defense. I've been sifting through USA spending. Here's a company I found in Nashville. They get $100 million a year, $100 million a year. It's Workwear Outfitters. I don't know this company. I don't know what they do, but look at their Google reviews. People are mad about this company. And these are federal employees. Listen to this review. This was a year ago. Okay. So this is under the Biden administration, a year ago. Workwear Outfitters is a subsidiary of VFC, which includes the North Face, Dickies, blah, blah, blah. Okay. Let's keep going. Their service is terrible and they should be fined right out of business for contract fraud. Orders placed online through the agency website take months. When an item finally arrives, it's usually wrong. Items are missing logos, printing patches, or just plain wrong. And when I return an item, it takes months more to receive a correction. The prices are significantly inflated over MSRP. I try not to use my annual $800 allotment because I believe it is ethically wrong. If they did business in this manner with their retail customers, they would fail immediately. This company is basically stealing from the taxpayers. $100 million a year. Now, Trump's going after these companies. And the question is Congress going to let them? Congress is going to create massive uncertainty. I do think that if Trump is successful, we could see mortgage rates in the fives in the next few months. I mean, I think people are naive to just how massive this change is going to be. The housing market, if you're looking at the U.S. housing market's going up or down, you are missing the boat completely, because what this is doing is it's targeting specific areas that are particularly vulnerable to federal funding, and that's what you need to pay attention to. So one way I think this could impact Nashville's housing market is if we look at the unemployment data. We can see that Nashville MSA has over 1.1 million people employed. In fact, we have one of the lowest unemployment rates in the country at 2.9, very low, below the national unemployment rate that's hovering around 4. And so what we can see here is that 1,000 jobs coming from like a Vanderbilt or even a couple thousand jobs is actually very small compared to the labor force. So unless this is a broadening, weakening, it really won't impact specifically in aggregate Nashville's housing market. Now, what it will do though is impact neighborhoods. And you can see from this tweet, I tweeted this the other day, that we had several layoff announcements along the I-24 corridor there, Murfreesboro, Smyrna, Antioch, Laverne. And what you can see is these areas have the largest increase in price cuts. Okay, so where we're seeing layoff announcements, you are seeing a spike in the number of price cuts in those areas. Now, some of these areas are actually very tight, but people are motivated to sell. They're nervous. So you can see that spike. If we had Vanderbilt or anybody else lay off 1,000 employees, you might see a spike in the areas where those employees live just because of nerves. Could it be broader? I think the only way it's broader is if there's a broadening, weakening in the economy. There's broadening of layoffs and the stock market drops. If the stock market drops, I think Nashville real estate will drop with it, especially Williamson County. I think Williamson County is going to be particularly sensitive to that. Now, when we look at demand, oh, by the way, if you are interested, I am going to post these charts for free on my website, NashvilleRealEstateData.com. All you have to do is sign up, and as soon as I post them, they will be free. They update daily. You can track your county. I will email you and let you know it is available. That's something I'm working on right now. Now, when we look at demand, the Trump bump is gone. We can see here, we're now down about 5%, and it wouldn't surprise me if we saw this demand, which by the way, this red line is current year, the dark gray line is last year, and that light gray line is 2023. And this is just demand. This is a demand chart. It's 31 days of contract volume. And I plot it every single day to see how demand is changing over time. You could see we could potentially crest at a lower point, maybe 5% lower. And what's weird about that is we're starting to see year-over-year mortgage rates go below last year. My thesis is that if they go below, we'll see demand higher. But if we don't, that would be a very recessionary signal. We'll be watching very closely for that. It could change quick. Look how quickly it changed in the last week. Last week, we were tracking, just 2 days ago, we were tracking with demand, and now we're starting to see a change in that demand. And so it kind of makes you wonder, is demand slowing down? Now, one of the reasons I think it's so important to look at individual neighborhoods is because even though this is down 5%, look, it's down 5%. It's only down about 100 contracts. When you spread that all over Nashville, you kind of wonder, is it in specific areas? And that's why we have this hot and cold chart by neighborhood. And you can see here, there are some specific areas where contracts are down, and there's even other areas where contracts are up. So it's not evenly distributed. It's kind of important. I mean, even Murfreesboro, look at this. More contracts on the west side of Murfreesboro. And then when you get closer to Smyrna, Laverne, Antioch, you can start seeing more blue. That's where those price cuts are starting to increase. Look up here, we can see that contracts are fewer in the Green Hills area, in the 12 South area. They've started to slow down a little bit, starting to see a buildup of buyer's market. And that, to me, is the most important thing about this, is whether or not you're in a buyer's market in the neighborhood, okay? I don't know if prices are going to go up or down, okay? But what I can tell you is where buyers have the advantage and sellers have the advantage. It's kind of like counting cards. And it's really interesting. You know, someone said this is not statistically significant. And I thought, you're right, it's not. It's not intended to be. What it's intended to be is for you to understand the neighborhood you're buying in better than anybody else from a data perspective. Let me give you an example. Here we can see 12 South right now is pretty soft. Okay, when we look at the active listing, we see there's 53 active listings. There's 7 that have gone under contract in the past month. Okay, it feels like when you take that ratio, it feels like almost an 8-month supply of active listings. However, when you look and see that 135 have closed in the past year, it's really closer to a 4 to 5 month supply. This means that it feels much softer than it is. The neighborhood softened up actually quite a bit in July, August last year, and now it's softening up again. Definitely something to watch. Now let's contrast that with West Haven. Okay, West Haven's a shocker. I couldn't believe it. Which, by the way, guys, the blue line is supply, the red line is demand, and the green bars are price cuts. That's really important to know. But West Haven actually had one of the tightest housing markets it's had since May of 2023, and then pre-interest rate increase. Seller's market, seller's market, seller's market. When we see that gap create opportunity, just a month ago, 6 weeks ago, great opportunity in West Haven. Now it's as tight as it's been in years. This is why it's important to know the dynamic. If I was selling in West Haven, I'd be like, hey, now's the time. If I was waiting for March or April to list, I would have probably listed 4 weeks early if it was ready, just to get in front of that tight supply. And you can see transaction volume stabilized. Even here, you can see it. We had a low in July, but it's been kind of going up ever since. From a price per square foot perspective, it looks like the lows are getting high, looks like the highs are getting higher. And that to me is a sign that this neighborhood's strengthening. So if you know that as a buyer, and if you focus on the areas as a buyer that are green, you're gonna have those advantages. You can be a little bit more aggressive on the offer. You can take advantage of the opportunity of a seller looking across the street and seeing their neighbor sell and getting nervous. That's what this is about. It's like counting cards. It's shifting advantage into your favor, whether you're a seller or a buyer, by looking for the red and the green. With that, I hope you all have a great rest of the day. I look forward to seeing you on Saturday. Thanks a lot.